Hey, it's Ryan from the Option Income Advisor, and this is the trade of the day for August 13th, 2021. It's actually Friday the 13th. Hopefully that's not a bad omen for for this stock, but we're going to talk today about Micron Technology. So you probably saw the sell-off. It was probably one of the larger sell-offs just in our universe yesterday. And it's interesting that a stock can move off of a report or kind of one opinion out there, but that's kind of what happened with Micron. There was I think Morgan Stanley came out with a note, and it was called the winter is coming, specifically for Micron's kind of sub industry within the semiconductor industry. They do a lot of DRAM memory chips, it's a commoditized product. It is, and that's always been, I think, the downfall, if you will, of Micron stock. There's so many great chip manufacturers out there that get all the press. Recently, AMD, Nvidia. Obviously, Intel's always in the news. Lam Research. So there's tons of great stocks in that industry, and I think it's almost as if Micron's kind of been the stepchild, right? And the reason being is that, again, they're a large business with scale, but it is a commoditized product, so it cycles very hard. When supply and demand contracts, and so that's kind of what Morgan Stanley is saying in their note, right? Is that we've had high demand with lack of supply recently, so earnings have come up, but they're expecting now that kind of dynamic is working itself off, and now we're going to shift to the other side of the cycle where there's going to be an oversupply of these chips, right? And so, it's tough when one analyst comes out and says something. So you really got to take a look at the stock. We're going to go through all the fundamentals and the charts because I think this stock has sold off quite a bit. And so the question is this slowdown, this predicted slowdown, is it something that's already been priced into the stock? And keep in mind, this is one analyst's opinion. I think there's 33 analysts that cover the stock right now, so it's a widely covered stock, and 26 of those 33 either have an outperform or a buy rating still on the stock, whereas Morgan Stanley is one of 7 now that have a hold rating. So no one has a sell, but there's 7 hold ratings on the stock, and they actually reduced their target price from 115 down to 75, and so the stock's currently trading right around 70. So we can actually get into the stock profile here, because that's a good segue into the data, right? So you can see, Micron sold off 6%, and this was purely driven by this report that was put out, right? So stock's trading around 70. Again, Morgan Stanley reduced their target price to 75. Now the consensus target price for all analysts is still right around 113, so obviously much higher. So the question is Morgan Stanley the first of many to assume that the cycle's coming, or quote unquote the winter's coming for Micron, or is this kind of a one-off analyst that again doesn't understand the cycle as well as some of these other analysts, right? And so that's the issue you always face when you get one. I'm not going to call them rogue, but you kind of get what I'm trying to say here. When you get one analyst coming out and saying something profound, and that all the other analysts certainly haven't said anything. Actually, there was a few that came out yesterday and kind of reiterated, well, I think maybe some of these concerns are overblown. So we did have a little bit of that going on, but just kind of keep that in mind. It's the market tends to overreact to things, especially when you get a downgrade, because the fear is that there's more downgrades coming, right? And so that's the one thing we're going to be watching. But I would say, this stock has already been selling off. Pretty much in a straight line from April when it peaked around, $97 a share. It's basically trended down from 97 to 70 in, over the last, 3-4 months. But it's been a downtrend, right? And so I think a lot of this kind of upcoming cycle for this business is probably being priced in already, right? Because if you look at the valuation, which we'll look at here in a second, it's a pretty attractively valued stock right now, especially based on these kind of peak earnings that they're having right now. But because of that, because of the way it cycles, Micron's always traded at a low multiple compared to a lot of their peers that are in subsegments of the semiconductor industry that aren't commoditized. So just looking at some of the rankings, just high level, you can see we've got a safety rating of 7 and a value rating of 10. So this type of stock would come up on a lot of your screens, right? if you're screening for safety and value, this stock's going to come up certainly on your screen. And I think it makes a great triple income wheel play. It makes a great play to sell puts. And so our strike zone is 61 to 64. So the question is, can we find a good put down in this strike zone, given that the stock's kind of already sold off quite a bit? We don't have earnings risk. So this is going to be kind of just pure cyclical volatility that that we'll be trading here. Very liquid stock, and options. It's got our highest liquidity ranking. It's got about an average volatility ranking, so roughly 37% implied volatility. You can see the historical volatility has been around 43%. So again, probably on the average side. But the pullback indicator is a 10. So all of these factors kind of go into this required minimum margin of safety. So that's kind of how we come up with that 8%. And so that pullback rating of 10, we've sold off about 28% from the high. So that's a pretty good pullback on a stock that has a 36% implied volatility. So we've already sold off 28% on a stock that has a vol under 40, which I think is a pretty reasonable pullback for a stock like that. So interestingly enough, this stock actually just 2 weeks ago announced their first dividend payment. So as of a few weeks ago, Micron's officially a dividend payer, and I kind of like what they said, honestly, whenever they announced this. So they're kind of changing just the way they distribute cash to shareholders, or utilize cash for shareholders. And so I think implementing the dividend is a good sign of stability, I think, for the business. There's probably a lot of potential for future increases in the future. You can see we only have a dividend yield of about 0.6%. So nothing to get too excited about. But again, like I said, the payout ratio is pretty low. For the time being. So, there's some room to move there, but they've also done a good job of repurchasing stock over the years on a pretty consistent basis. I think since 2018, they've repurchased $4 billion of stock, which is, nothing to sneeze at, but they also changed just their strategy for buybacks. And so because it's a company that cycles and it's a known cycle, they're going to start waiting to repurchase shares until kind of the trough of the cycle, right? So they obviously know their business the best. And so instead of making consistent buybacks over time, this company says we're gonna isolate some of the best times to repurchase our stock, which we know the best, and we're going to put the most money to work, when we think we're at the low end of our cycle, which I think is pretty attractive there. So let's take a look first just at the chart, and then we'll get into some valuation and some cash secured puts specifically for this stock. So here's the chart, and so look, this this one's not the best chart in the world. This stock literally traded in a range for quite some time, and again, I hate to use this term, but you kind of get the gist of what I'm trying to say. It's no disrespect to any stepchildren out there, but this stock has never been a loved stock. It's volatile. Again, it's traded in some ranges, but that doesn't mean that there's not good opportunity, right? It doesn't mean that we can't make money off of this stock by selling puts, right? It's with anything else, with any stock we look at, right? It really comes down to just pinpointing the right levels, right? And so, this stock was trading in a pretty wide range from say 60 down to kind of 30, right? That's a pretty wide range for a stock over a several year period. Then kind of right here, so that was November of 2020, it literally broke out. So it looked like it was going to break out before COVID, and then COVID just kind of sent not that it was a false breakout, because obviously no one could have predicted what happened here, but with the pandemic. But it looked like it wanted to break out here in February. Instead, it sold off with the pandemic. Kind of proceeded to trade up with the rest of the industry as as I think the demand for chips, their chips are in PCs, smartphones, servers. So obviously things that were being utilized and there was high demand for, right? So the stock proceeded to trade up and actually broke out here in November, right? So not only did it break through that pre-pandemic level, but it broke out from its kind of peak back in May of 2018. So that was a pretty significant breakout. And so you've heard us talk about just significant breakouts, because you can see there's plenty of follow through here. So this is a real breakout here at 62.5, and so that level I feel like is kind of the down, the kind of lower support level over the short term of where I think the stock could potentially go. Because when you look at a chart like this, you've now got the price that's broken through both its 50-day and 200-day moving averages. You've got the 50-day turning over and potentially going below the 200-day moving average. They're just within sense of each other right now. You've got kind of a not the best kind of support level here, because this was during this pretty big breakout and follow through. So this low here from kind of late 2020, right around $70 a share. We'll see if that holds. I mean, that's right where we're at right now. So it's kind of testing that level now. So if we get a bounce from here, I actually think that's a pretty positive sign. And we may not hit this level, but I mean, I would think that, with any further sell-off, you're probably going to come close to testing this kind of 62.5 level, maybe even the 60 level from here. But I think this 62.5 that's the kind of strong level of support, because that was a real multi-year breakout for the business. So that's definitely the level we're watching. So if we can get a put kind of in that range, I think it makes sense. Again, our strike zone is 61 to 64, so this is actually right kind of in the middle of our strike zone. So from a valuation standpoint, again, we kind of talked about this a little bit. This company has always traded a low multiple. I mean, when you look at the 5-year average, given if you compare it to some of the higher growth names in the semiconductor space, I mean, this company's always seemed to be attractively valued, right? Because it's always kind of traded at this low multiple because of the cyclical nature and commodity nature of its business. But we've had quite a move in just in earnings recently. So obviously pre-pandemic, the company was kind of already going through a cycle, right? And so their fiscal year ends in August. So this fiscal year 2021 is almost over, right? But the company is projecting about $11.40 for fiscal 2022. So this would be 2022. And then it's kind of supposed to level out from there. So 2023 also is kind of right in that $11.50 range. So we'll kind of see what happens, obviously, in the future. But this could be peak earnings, and I think that's what Morgan Stanley is trying to say. Like this demand that we're seeing here in 2022, that's almost taking this back up to peak earnings level that they recently saw in 2018. May start to turn over here. So you may see this, cycle kind of like what it did, just back in the, 2018, 2019, 2020 range. So we'll see, but, the stock tends to, sell off prior to that. So I think we're getting a lot of that sell off, assuming that this is going to happen. But I think there's a chance that it doesn't. And I think that's what some of these other analysts are saying, is that, yes, the PC market may be slow. Some of these sub-markets that they're in may be slow, but there could be some that still have to work through, some of the supply demand dynamics that they've been going through. I know, there's still going to be high demand for smartphones. That's 40% of their sales, their DRAM sales. So, those are the type of things that could be kind of upward surprises from a supply demand dynamic that could potentially keep these earnings at a high level for several years. So we may not see this turn, right? What we may see is, okay, we've got high earnings from all the demand here, but if they persist, we could have earnings, just kind of flatline for a few years, which would be a huge positive for this stock, because based on future forward earnings, I mean, we're looking at $6 or a 6 times multiple, which, I mean, there aren't many stocks you can find out there that have a 6 times multiple on it. So I think it's attractively valued. It's really this whole dynamic here that is kind of up in the air. But at the current time, the consensus is that we're going to kind of be flat in 2023. So the analysts, other than Morgan Stanley, have not predicted we're going to see this downturn in 2023 yet, right? And so I think it's too early to tell, but I do think the stock has probably overreacted to this note, and I think it again. This is what gives us the opportunity to write cash secured puts. When we can find situations like that, like this, where the stock has been selling off, and we have a situation where there could be potential upside surprise as far as earnings not selling off, right? And we're giving ourselves enough margin of safety anyway, where we aren't as concerned, about, additional sell off, right? So, this is just an attractive opportunity, I think that we've been given here. And so that's why I always, when we talk about building that master watch list, right? Is Micron a stock that I'm always looking at? No, but it's on my master watch list because they're a leader in their industry. Yes, it is a commoditized industry, but they are an absolute leader in the DRAM market. And so it's a relevant business, within a much broader, sector that it just has to be on your watch list. Because as you're looking at your watch list every night, and a lot of I sort my watch list by what the stocks had returned the previous day. So I look at 1 day returns because I want to know when there's situations like this when a stock is sold off, because it gives me some ideas to dig into, right? And so from time to time, stocks like Micron will just pop up on my list as something I need to go look at, right? And so this is that time, and this is why it's important just to kind of stay organized, keep your watch list, intact, so that we can, we can take advantage of this. So let's take a look at the September. So we're still selling September options right now. September 17th is the monthly. And so, again, base strategy, we're looking for 1%, ideally in the strike zone. So what we've got here is we've got no EPS risk, right? Which I love. We've got several in the strike zone here. So the top end of our strike zone is 64. So that's why the 65 is out. And then, so the 62.5, remember that 62.5 is pretty much the exact breakout level. So I look at this and I love this trade already, right? That's the level I was targeting. I can still get 1% per month. So I'm hitting my target here. It's got a delta under 20 at 16. I got an 11% margin of safety, again, without having to take any earnings risk. So it kind of checks all the boxes for us, right? And I really like that level of 62.5. I think that's the one, when looking at the chart, that I think could have some real support behind it. So on the conservative side, that one's easy. You just go down a little bit to that 60. Again, remember there's an additional kind of support level down below 62.5, right around 60, which was the pre-pandemic peak. And then, so we've got, about 0.7%. And then we've got an 11 delta, 15% margin of safety. I like that. And then for the aggressive side, again, I think there's a chance that this thing could hold 70, right? I mean, we're bumping up against it right now, but look, we only got 36 more days. If you get any more analysts come out this week or next week and say, hey, I think Morgan Stanley was totally wrong, we're reiterating our buy and we're reiterating our price target of 115. Well, this stock seems real cheap at 70, right? So I think from the aggressive standpoint, I think you could probably even go up to this, 67.5, which again is just a little bit below where we're at right now. So we still have a 4% margin of safety. It's a delta on the higher end of what we would look at, 30, 34, but, it does give us 2.5% average monthly yield. So again, that's the aggressive side. But just kind of looking at the chart, knowing that this stock, I think, is already trading at a pretty attractive valuation. I think it's been hit hard enough. And, a lot of this, I think there's been quite a lot kind of priced into the stock, if you will. And so I think my initial reaction to the move just over the last week is that, the stock is pricing in further downgrades or more downgrades. If we don't get them, I think that's a catalyst for the stock to certainly stabilize here, but possibly pop a little bit. So those are our levels for Micron. Again, it's really important to stay organized when you're trading this strategy. You never know when a stock like Micron is going to pop up and become an opportunity. So you gotta have it on your watch list so that you can take advantage of these opportunities when they pop up. So that's all I have for the day. Let me know if you have any questions. Take care.